Imagine this. You have a revolutionary idea, a product with the potential to change the world. But you lack the resources to bring it to life. Traditional loans seem out of reach, and the stock market feels like a gamble. What if there was another option, a hidden world where brilliant ideas meet the fuel they need to explode? This world is venture capital, and it could hold the key to unlocking the potential of your next big idea. But before you get starry-eyed, there's more to the story. Venture capital isn't a magic money tree. It's a complex ecosystem with its own set of challenges and risks. So, is venture capital the right fit for you? This video will peel back the layers of venture capital, demystifying its inner workings and revealing the opportunities and risks it presents. We'll explore how venture capital works, who the key players are, and how you can navigate this exciting, yet often misunderstood, world. If you're yet to subscribe to this channel, we really encourage you to subscribe now and hit the bell icon to be sure you'll always get notified whenever we release a new video. This will also encourage us to produce more amazing contents like this. What is venture capital? It is a specialized financing method that provides funding for early-stage, high-growth companies with the potential to become industry leaders. Unlike traditional loans, venture capital firms invest directly in a company's ownership, that is, equity, in exchange for a stake in its future success. So, why does venture capital really exist? Traditional lenders like banks are hesitant to finance nascent businesses due to the inherent risks associated with early-stage ventures. These companies often lack a proven track record, established financials, or tangible assets to secure loans. Venture capital fills this critical funding gap, allowing promising startups with groundbreaking ideas to access the resources they need to develop, scale, and disrupt their respective industries. And how do venture capital work? Venture capital firms raise capital from a pool of investors known as limited partners, LPs. These LPs can be individuals, institutions, or pension funds seeking high returns on their investments. The venture capital firm then manages this pooled capital, acting as a general partner, GP, responsible for identifying and investing in promising startups. The venture capital investment process involves a rigorous selection procedure. Venture capitalists meticulously evaluate potential companies based on various factors, including the strength of the founding team, the market opportunity, the scalability of the business model, and the overall growth potential. Once a company is selected, the venture capital firm negotiates the terms of the investment. This includes the amount of funding provided, the valuation of the company, and the percentage of ownership stake acquired by the venture capital firm. Beyond just providing capital, venture capital firms often offer valuable strategic guidance and operational expertise to their portfolio companies. This can involve mentorship, access to networks, and assistance with recruiting talent, marketing strategies, and business development. Please note that venture capital is different from private equity. Click on the card above, watch our video where we demystified the term private equity and what it actually does. Now, let's highlight who the key players in the venture capital ecosystem are. In the venture capital funding ecosystem, there are 4 key players. 1. The venture capital firms. These are the institutions that manage the venture capital funds and make investment decisions. They employ experienced professionals with expertise in specific industries and a keen eye for identifying promising startups. 2. The limited partners, LPs. These are the high-net-worth individuals, institutions, and pension funds that provide the capital that venture capital firms invest. 3. Entrepreneurs, the driving force behind startups. These individuals possess innovative ideas and the passion to build groundbreaking companies. And finally, 4. The angel investors. These are wealthy individuals who invest directly in startups at a very early stage, often providing crucial seed funding. Just a pause here. If you're yet to subscribe to this channel, we really encourage you to subscribe now and hit the bell icon to be sure you'll always get notified whenever we release a new video. This will also encourage us to produce more amazing contents like this. Thank you. Now, what are the different types of venture capital? Venture capital typically comes in various forms, tailored to meet the needs of different stages of a startup's growth and different risk appetites of investors. Here are the main types. Seed funding. This initial stage provides capital to validate a business concept and develop a prototype. Early stage funding. This stage focuses on helping startups refine their product or service and gain initial traction in the market. Growth stage funding. This stage fuels rapid expansion for companies with a proven product market fit. Later stage funding. This stage supports established companies on the verge of an initial public offering, IPO, or acquisition. It is also important for you to know that venture capital firms may specialize in specific sectors like technology, biotechnology, life sciences, or clean technology. So, what are the benefits of venture capital? Here are a few. 1. Fuels innovation. Venture capital fosters a culture of innovation by providing financial backing to groundbreaking ideas. 2. Job creation. As startups grow thanks to venture capital funding, they create jobs and stimulate economic activity. 3. High returns. Successful venture capital investments can generate substantial returns for limited partners and venture capital firms alike. 4. Market efficiency. By supporting disruptive companies, venture capital helps drive competition and keep markets dynamic. Here are some of the risks and challenges of venture capital. High failure rate. Many startups fail, resulting in the loss of invested capital. Long investment horizon. It can take several years for venture capital investments to yield returns. Limited liquidity. Venture capital investments are illiquid, meaning they cannot be readily converted to cash. Information asymmetry. Startups are often young and have limited data, making it challenging to accurately assess their potential. Venture capital plays a critical role in fostering innovation and driving economic growth. By understanding its purpose, how it works, and the key players involved, you gain valuable insight into this exciting and dynamic world. Whether you're an aspiring entrepreneur seeking funding or an investor considering venture capital opportunities, this knowledge can empower you to navigate this complex ecosystem effectively. And if you're interested in understanding the term private equity, click on the right video on your screen right now. And by the way, if you're yet to subscribe to this channel, please consider subscribing now and hit the bell icon to be sure you'll always get notified whenever we release a new video. This will also encourage us to produce more amazing contents like this. Thank you.